let's look at what's happening in the stock market right now. Right, we have, well, is everything up, really?
Actually, I'm hoping.
Well, let me see. We're at, let's look at the stochastics for where we're at. We're at basically at for every stock we're watching, most 90% of stocks are in the same pattern. We're overbought, and we're at the top of the range of our downward trend. I think that's why we're fluctuating a lot right now. The market basically, if we're following the trend, we're going back down to the bottom. We've been zigzagging down for quite a while. We know that whenever there's a change for the Fed to support the market, we're basically going to stop the downtrend and start the uptrend. But everyone's wondering when that's going to be. And this is a Friday, so Fridays traders usually get rid of their inventory so they don't have to deal with news stories over the weekend. So we can't really expect too much out of what's happening with the S&P today. So we're at the top of this range. Look at every stock, every index we're following. You can see we're overbought. Usually when you're overbought and you're at the top of the channel, the next stop is down until we have a break in trend. Until we break out of this downtrend, it's lower highs, lower lows. All right, so you can see almost every index we're following, we're at the top of that range. Healthcare is sideways, almost everyone. Utilities, they're pretty sideways too. And almost every stock we're following has basically been rallying. People are bullish, and if we look at our meeting notes, we're approaching the Thanksgiving holiday. So today, on Fridays, we have to make a mental note that there's a natural tendency to sell for traders to reduce their inventory. But next week we have Thanksgiving. We always hope for a good week, but we're overbought, so we don't really know. It could keep going, or the things to think of in the future are the Fed meeting in December 14th, and in February they're meeting. So all the indications that I've heard, the Fed probably is going to raise 50 basis points on December 14th, and maybe a little bit more, 25 in February, and then we're off to the races. But I've read some research that says as soon as the Fed pivots, the stock market goes down after that. So we have to be very careful what we wish for here. All right, so we also have the end of year rally to look forward to. Usually right before Christmas, and then towards the end of the year we have end of year window dressing. A lot of good feelings in the air. So that's kind of where we're at. Let's look at the. This is our talking points we always go back to. The 10-year is basically unchanged since last week. The 2-year is up 3%. That's bad for the stock market, because that means the Fed would have a tendency to raise interest rates higher to match that. Okay, and the Fed is still reducing the balance sheet. That's quantitative tightening. The things that we're looking for a catalyst to go up and catalyst for the market to go down. We have Walmart had good earnings this week and they went up, and Target had bad earnings and they went down in a big way. So let's look at that. We were saying for quite a while that in a recession, people will tendency to trade down. So you'd have $100,000 earners that would normally shop at Target now go to Walmart to cut some costs. And that's like a theme we're going to be watching, see if people are actually cutting back. And so Target, they're still having inventory problems where they have to sell excess inventory for a lower price and their profit isn't as good. Okay, so we don't really have any any plus or minus for catalyst going up. We're still overbought. So that's an indication we're probably going to go down next. And the 2-year is up. That's an indication that we're going to go down because that's not good for stocks. And we're going to keep our eyes on that 2-year and 10-year. What else? What else happened in last week? All right. So our new plan is we're going to have slightly higher interest rates and probably flat, and they'll hold them steady for a year. What is the game plan for that? And if that is the case, we're looking for lower PEG ratio stocks, and we're looking for growth stocks that have been thrown out with the bathwater that are still growing, and we're looking for the safe business models with consistent demand over time. And I think Jim Cramer used to say accidental high yielders. So that's quality stocks that have higher dividends. And also during this time, we have to look towards the income part of our portfolios. So right now we have chances of getting maybe 8-10% return on fixed income, like bonds and other more stable investments. So those are the things we can look forward to in the next 6 months to a year, because higher interest rates won't be there forever. All right. So here's some major variables in the stock market. Oil fell down to 77 this week. That's down 14%. That's pretty big. So we were talking for a while, last couple of weeks, about if there's a recession, which it's kind of likely, according to a lot of famous people, the price of oil will go down because of lack of demand. So if there's less buildings being built, less stuff going around in cars and trucks, then there's less demand in oil. And with China being in lockdown, they're not going to have as much demand either. So it's down to 77. So that's going to affect all the oil stocks. So the uptrend we've seen in the XLE, let's look at the XLE. This uptrend, it's continuing from the beginning of the year. This is probably the only major sector of the market that's still positive for the year. And the one thing we talk about towards the end of every year is reversion to the mean. So right now, the energy sector is still kind of reverting to the mean in an uptrend. So right now, oil stocks or energy is only 2 or 3% of the S&P 500. These PEs of these stocks are still low, and they still have dividends. So I guess you can say that the energy sector still is trying to revert to the mean, which is they're going to be maybe 10% over time of the S&P 500, maybe higher multiples and higher PE ratios. But that's all at the mercy of the price of oil, it seems. Okay, so the U.S. dollar is pretty much unchanged. So we're watching this. If it went down the last couple of weeks in a pretty major way, if it continues to go down, that's really good for our big tech stocks and any stock doing business overseas. All right, so let's look at sectors. See what sectors, we know the oil stocks are going down because of the price of oil. So let's look at change in price of oil, of course, right. So energy and oil. So maybe in the short term, there could be a reversion from what's been working this year, which is oil, to some of these stocks that have been out of favor, that have been sold off for a while. Telecom has been in a downward trend for a long time, and utilities, healthcare. Seems like a very conservative mix of indexes. These are high dividend stocks that are conservative. Real estate, retail. Okay, and you see technology is basically flat for today. Okay, that's interesting. Okay, so let's look at like a percent changes for the S&P. So which ones are going up the most and down the most. All right, so we have Live Nation. This stock was hit in a major way during the pandemic because they have live venues and they were shut down for a year. And they actually have a problem here. This is the story right here. Taylor Swift slams outside entity over ticket fiasco. It's basically Live Nation owns Ticketmaster, and Ticketmaster has a monopoly on ticket sales in America. And there could be an argument that they might have to split the company up because they have the venues where the music, they're organizing the musical events and they're organizing the sales of the tickets. So that's probably why they're down. And there's a big fiasco where Taylor Swift had a concert advertised and Live Nation's jacked the prices up too much and everyone's mad. So let's see what happens. There was some congressional talk about that. But let's look at Live Nation, LYB. That's an example of a stock. LYB. We'll have to get better at watching, stocks. This is a stock that really took a hit during the pandemic. They went down to 29. And of course, there was an unknown amount of time that the pandemic would happen. So they might, if they wouldn't be able to run their venues and sell tickets, they could have been out of business. But that was basically a really good time to start buying that. So we'll start looking at stocks that have fallen out of favor in a major way like that to see if, we can see 2-3 years down the line if there could be, they could come back in some way. So they're at 66 now. Okay, let's look at their fundamentals. Statistics. Okay, so PE ratio is 67. So that's pretty high. And profitability, return on equity. Okay. So it's, and they don't have a PEG ratio. So they're still basically trying to recover from the pandemic and get people back into going to live camp concerts. And a lot of these numbers, a lot of these are negative. So return on equity, okay. Let's look at, this is an example of very rich stock. It's very high PE ratio, and normally in an environment like this, that would get hit a lot. We're going to look at their fundamentals and see what the analysts are saying. LYD. Okay, so you can see in 2021 they had major losses from the pandemic, and they probably incurred a lot of debt during that time. So we didn't really look at that. Live Nation, let's look at the debt. Total debt, $7 billion. And their total market cap that's half of their market cap, almost. So they have a lot of debt. That's one big problem with that company. So during this pandemic, they acquired a lot of debt. Now, a big problem for them is they're going to have to refinance that at higher interest rates. So you can see this is pretty inconsistent. So it's a very fragile business model, depending on, whether people go to these concerts or buy tickets. Now, on top of all this, they have a problem where Congress might have to do some kind of analysis if they have a monopoly in this or not. So 0.81 divided by 1.22, that's 34%. 1.22 divided by 1.66. So that's 27%. So they're basically twice 2 times overvalued. They're growing at like 20, 30%, 27%, but their PE ratio is 67. So that's an example when we looked at the chart for this. In a really bad market environment, the stock goes back to its PEG ratio of 1, and this went down at 32. That's a PEG ratio of 1. So we'll watch for it to go back down to 29 before we start looking at that. All right, so what other things are going up? A lot of the energy stocks. Energy stocks. That's all of them. NVIDIA. Okay, so NVIDIA just came out with earnings, and thinking what other things? Healthcare. Okay, so we have healthcare. We have utilities that are top gainers. This is going to be interesting. Does anyone have any ideas what sectors are going to be doing good next year? So this year we had energy, we had utilities, and we had healthcare or drug makers doing good. Anyone have any ideas of what would be doing good next year? Usually it's a flip of what was not working this year is going to be working next year. So we'll have to keep waiting to see if let's say the tech, which is really bad this year, turns around for next year. Let's look at the NASDAQ. Oh, these are all the stocks we've been saying for a while that are high PE ratios. And I guess what's happening, let's look at the 10-year treasury. But that's going up. Okay, so that makes sense. Whenever the 10-year or 2-year goes up, stocks go down. That's our formula. Okay, so that's why we have what we have today for the decliners and gainers, I think, because as the interest rates go up, that makes it bad for the high tech, for the high PE multiples. When the stock and when the high PE, when the treasuries go down, that's good for the tech stocks. So it's a pretty simple formula. It's working again. Okay, now let's go back to my meeting notes. Okay, so you can see where we have a bullish sentiment right now. We have a greed. People are pretty greedy. They think that we've been going up. It's probably 10% in this little uptrend, but you can see we're making higher highs, higher lows up until we hit this channel, and then before you know it, we're going to go back down to here. And right now we have this indecision in the market. We don't know if it's going up or down, and the whole market's kind of waiting to see if we break out of this or not. And so until further notice, we're going to be making the zigzag down and keep going down until we decide to break out of this. Now, let's look at that. Okay, VIX is basically unchanged since last week. This 23 PE isn't, the people aren't scared. That's pretty complacent. And we're oversold in the VIX. So it's usually at this time when people that are traders, they sell, and then they buy whenever the VIX gets up to 30 or 35. Okay, so this is kind of a chart that has been mapped out. I saw it on Twitter and CNBC. The U.S. Consumer Price Index. You can see that in June, we basically plateaued. A lot of the statistics around inflation and consumer prices, they plateaued around June, and they're starting to go up less. And hopefully this trend continues where the next report's like this, and then we get down to 2% maybe in a year. And whenever reaches that 2%, that's the time when the Fed will basically ease off and start accommodating the economy again. So we do have this trend in a lot of the statistics. We can see from our gas, we're paying less every month or so, and every, a lot of things we're following with lumber, and they're all going down. So I think we can see that. We could probably map the corn price, almost every commodity, to a graph similar to this. And Jeremy Siegel was saying that, the Fed's probably not looking at the right numbers, because everything is pretty much, all the inflationary signals like the housing, et cetera, they're plateauing and going down. So if we look at our meeting notes for our calendar, we're going to probably raise the interest rates 50 points, and maybe another 25 in February. So, and then we don't know, usually right after they make a pivot, let's say if they pivot here, the stock market usually goes down. And for the past, I don't know how long existence of this, every time there's a pivot, the stock market goes down for a month or two in a major way. So that's why we're not expecting too much out of the beginning of the year. All right, so let's go back to our talking points here. Okay, so there was some of the things that are rattling the market is there are members of the Fed that are kind of giving little different reports. Some are hawkish, some are dovish, but this guy is like, the Fed might raise interest rates to maybe up to 7% at the max. So that really messes up everything in our chart, because if they do that, they're going to raise like 75, and then maybe in April, or here, March, they'll have another 75 or something. So that'll mess everything up. Everything will be red for the market if that happens. But next year, this guy's not going to be voting. He shouldn't have even said that. This Fed, the Bullard guy. So but anyway, I hate to make this into a Fed speech, but that has 90% of what's going on in the stock market has to do with this. So, all right. So let's go look at what Carl Icahn said. Carl Icahn, he's an investor, he's an activist, and he's been around for a really long time. He was around in the 70s when we had inflation. He said inflation is basically not going away fast. It's not that easy. You can't just look at this chart and say, oh, we peaked and we're done. He said it's going to be around for quite a long time. So he still has hedges on, meaning he still thinks that we could, be in for some real big drops in the stock market. He says he's short the S&P because S&P has a lot of tech stocks that are too high for the most part. And he thinks with higher interest rates, they're not worth what they're selling for. But he buys a lot of unique situations. Like he bought Crown Castle. They do food packaging like cans. And he said, there's an environmental push right now in the stock market. See CKK. Crown Holdings. So this is an example of the stock that he just bought. He's trying to make a big position in it. He thinks that they make let's say canned goods for manufacturers of goods, and you can see that this is really pretty expensive stock. Its PEG ratio is 6. That means it's not growing. It's 6 times overvalued. So its 4 PE is 11. That means it's growing like a 2 or 3%. And these numbers are kind of negative. So I don't know about that. But, he has these theories on the big picture where, people turn to ESG and they're getting rid of plastic, and they might want to put more things in cans. That would help that company. But he likes making these big bets on, certain stocks that people follow him, so that begs the stock on. Thinks that the crypto space is like the Wild Wild West, and he thinks there's no rules there, and it's just like a huge gamble. He's staying away from it, and he thinks some of these problems in the crypto space could rub off on some other sectors. He's not sure yet, but all right. So there was an article on this Motley Fool. It says 3 of the most popular stocks on the planet could plunge 44 to 57%. And it mentioned one of the stocks we're following, Tesla, and Bed Bath & Beyond and Netflix. And we've been saying that Tesla and Netflix are overvalued for a couple weeks now, no, a year now. But we're going to go over the fundamentals just for fun, just to see where everything is now. Okay, let's look at, this is Tesla. You can see from its earnings estimate from E-Trade, it's growing around 20%. So next year, 28, the year after 20, and then it slows down to 6%, 3 years. So right now that means if it's a PE of 35, it's almost 1.75 times overvalued. So we can see Tesla going down probably in half and be fairly valued. So you can see its PE is 35, and this matches our PEG ratio that we came up with, is 1.75, and this is 1.5. That's pretty close. But the statistics are good for it. The profit margin is what we like, and we like return on equity. And so that matches our findings. Let's look at Netflix. So we're looking at its annual earnings and estimates. And for this year to next year, it's growing only at 2%. So right now with Netflix, they're not making a whole lot overseas yet. That's one place they can grow. They're pretty saturated in America. What they could do is they're trying to go into advertising. So they didn't have an advertising model before where you show ads at a lower cost per month. And so they're trying out that business model. They don't know if that's going to work or not. And on top of that, you have a lot of streaming competition now that you didn't have before. So let's see. So let's say they're growing at 20% and their P is 35. They've always traded for a very high P ratio, and it used to be 70 to 100 like 2 years ago. And now that they have competition, it's selling for a lot less, but it's still almost double price it should be. So if you look at its statistics, you can see that it's P of 35, and this kind of matches our 1.56. We had 1.75. So again, the return on equity is good. Profit margin is good. I guess the one problem with Netflix is Disney is actually overtaking them as the largest streaming provider in the world. So they have a lot of competition with Disney. Right. So this one is, we took a look at Bed Bath & Beyond. And this is the other one they had in their article. Tesla, Bed Bath & Beyond, downside of this. Okay, so far this matches what were our expectations. We said they were double what they should be. But Bed Bath & Beyond, they said 49%. Let's look at that stock. Okay, so this is their earnings estimates. I mean, the earnings for the past couple of years and for the future. This is an example of a stock that's very inconsistent, and it's been losing money during the pandemic. This is the pandemic here. They had a huge loss there, and now they're losing money again last year, even after the pandemic. And they're projected to lose money in the future. So this is a really, really risky stock, even when it's trading in single digits. It's trading, let's look at Bed Bath & Beyond right now. BPPY. Oh, it's down again. It's only trading at $3 a share, but you can see it's, let's look. This is an example of a stock. You see red in the earnings estimates. It's very inconsistent. Unless they have a path to profitability, it's going to be very risky. So let's look at the screen of, wow, it's down right where it was at the pandemic low. Look at that today. Wow. Okay, so it's projected to lose money in the next year. Maybe it's because in a recession, people don't want to look for coupons for 25% off to get something that's double the price at Walmart, so they just go to Walmart for everything. That's probably what's happening right now. People are trading down to Walmart for all their stuff, and they're not going to the ritzy places like Bed Bath & Beyond. Let's look at maximum. Okay, so this is the worst of the financial crisis. Yeah, it's at 17. Okay, so it's basically right back where it was during the depths of the pandemic today. So I bet you it has a lot of short interest too. Let's look at that. Now, short interest, that can work for and against you. It's a very good indication that it has bad fundamentals. It has a lot of short float. Wow. That's short percent of float. Jeez. I don't understand that. That's a lot of people shorting this stock. Okay, so the problem is they lost money during the pandemic, and now they're at a point where they're still losing money, and they have to borrow more to stay alive. They have to, whoever invests in this is basically betting that there's a short squeeze on any kind of good news. It's very risky. Okay, it's a very risky stock right now. It has negative earnings. All the numbers in Yahoo Finance for statistics are negative, and this is an example of it can go down way more than 50%. Like they can go bankrupt. So unless there's a white knight that's going to buy them out, it doesn't look really good for that company. So I wouldn't touch that. All right, so let me see. Okay, this is an article I read. I don't understand it that much, but there's something called future cash flow and discounting them back to today's value. And when there's higher interest rates, the earnings that you make today are worth less in the future if you have higher interest rates. I'm still trying to understand this, but there are people that actually value the tech stocks whenever the interest rates go up. When you discount whatever they make now to the future, it's worth less. And that's why tech stocks go down whenever the interest rates go up. It's so confusing. I'm still trying to understand that. But, you see. There was a guy on Twitter. It's a Dividend Dollar is his name. He mentioned one of the simplest ways to invest. You have you can invest in the S&P 500, total market, big tech, dividends, high yield, and REITs. You can just use these dividends and make a pretty diverse portfolio for American stocks and bonds. So he said a simple ETF is sometimes all you need. I thought that was pretty interesting. So we'll have to, at the end of the year, we'll have to see, decide which of these, will do good next year. Because a lot of the stocks and indexes that are doing good this year may or may not do good next year. Okay, where are we in this emotional chart? Okay, so everyone's bullish according to CNN's, where's it? Their greed indicator. So people are greedy right now. So this is just the time when the traders are selling. And it's called feeding the ducks. When everyone's excited and they are greedy, that's whenever the traders are selling, and that's whenever you have this big drop next. Because we're overbought, and you have to do the opposite basically of everyone else. For long-term people, you have to look at, we're here, it's going to drop, it'll be back here next year. So you have a little bit of a ramp. Sometimes it gets overextended like it is now, and sometimes it gets oversold. So can't let yourself get into this capitulation, I got to get out of the stock market, despair, okay, I sold everything, and by that time, it's time to take off again. Okay, so we're still going into the most positive time of the year. Everyone usually gets excited around the holidays, and there's end of year dynamics in the stock market we don't know about that happen, so we have to keep in mind that there's a normal push to the upside the last 2 months of the year. And let me see. Let's see what else is happening here. Go back to the S&P 500, see what's happening. Okay, we're still basically, this is the highs, high, high, and we're having a hard time breaking out of this downward channel. And the normal tendency at the end of every Friday is to sell off, so most likely, unless we get some really good news for interest rates, probably going to make another lower low before we go higher for the year, to the end of the year. Okay, so now let's look at Yahoo Finance. This is a good place to go for news. Okay, we can see that existing home sales fall for 9th straight month. Okay, so these higher interest rates are totally affecting the housing market. Housing market makes up, all in all, around 20 to 30% of the total GDP of what's sold in America. So whenever that's going down, there's a very good chance that the stock market goes down with it. You see. Okay, there could be just a contagion, where there's a lack of confidence in crypto, and until this FTX problem, there was a lot of people that had confidence in crypto, and there very well could be runs on companies, and that makes companies like Coinbase or any other crypto companies like MicroStrategy's very risky. And I think Kathy Woods has bought a lot of crypto-based things, and that makes her strategy that much more risky. So we were saying, was it 2 years ago? No, 1 year ago about, is Kathy Wood a hero or a zero? And I thought zero back then. And now people are losing confidence in all her predictions because they're becoming like pipe dreams. And she thought that Bitcoin would go up to 100,000 and never did. And so there's a very good chance that her ARK funds would go down because most of them don't have earnings. Right, so what else we can see here? Okay, this is very interesting how Elon Musk took over Twitter and he started firing people. I wouldn't invest in Twitter right now. It just seems like it's a very poor decision to get rid of a lot of people and then figure out who you really need. And just think of, if they took half the people that we're working with and got rid of them arbitrarily, how hard it would be to run the company. So I'm thinking Twitter is it's gonna have like outages, and it's gonna be really hard to recover from all that. I wouldn't invest in that. You see, so this isn't Jeff Bezos. He's telling people to be very cautious in your spending because a recession is coming. If anyone has the pulse on the consumer, it's the largest retailer in America, and he knows, what's happening. So the lesson learned from this article here of Jeff Bezos is right now, don't be overextended in your investing and in your buying things. So don't buy the big ticket items because basically, they're higher priced now. In a couple months, they're going to be lower priced because of deflation or, rising interest rates usually makes things cost less after a while. So there's a very good indication that Jeff Bezos thinks there's a recession coming, and that matches Jamie Dimon, Carl Icahn, a lot of other really smart people. So we have to have a plan for a recession, and Walmart is a good example of how to benefit from a recession. So, like for instance, Walmart people would have a tendency to trade down. They'd spend less, and they try to spend more at bargain prices like Dollar Tree. And let's see, other things going on here. Okay, whenever you listen to this stuff on CNBC, this guy basically made a fool of himself. He's Kevin O'Leary. He's Mr. Wonderful. He's been talking up crypto for a long time, and he owned part of FTX. And I'm just saying, I'm unsure if people are paying him off to hype crypto or not. But there's another guy on CNBC, Brian Kelly, that's hyping crypto. You never know what their ultimate motives are, but don't get suckered into that because it's basically it's all a scam. Let me see what else. Okay, so now this Fed to lift rates by 50 points, but peak policy rate may be higher. So what they're saying is if we go back to our December, we think everyone says that's like 100% chance that they're going to raise rates there. Maybe 25%. And then they're going to wait like 6 months to 8 months and then start reducing or keep it there for a year or so. But let's say that this is the last time that the Fed raises rates. For the next year, starting the last time that they raised the rates, from there for a year from then is probably the best time for us to get into fixed income if we're interested in that. So in other words, when rates are higher, if you want a certain portion of your money to be in U.S. Treasuries or something more secure, you want some higher yield junk bonds or something, that is the best time to start putting parts of that into your portfolio. I know Mark likes to ladder into fixed income. So put a little bit of money in, maybe at 5% U.S. Treasury interest. And then if they raise it another 75 points, then you put a little bit more in to a fixed income. So right now I don't have any real fixed income or bonds in my portfolio. Whenever I think, they're done raising rates, that's a good time, in general, to start looking at like high dividend stocks, high dividend treasuries, corporate bonds. I'll have to research that. I don't know a whole lot about that at all because that's not something I'm specializing in, but that's what you get from this article here. They said Fed to lift rates by 50 points, but peak policy might be higher, and Bullard said it could be up to 7%. So we see that Twitter workers are basically a large percentage of engineers from Twitter were presented with either work hardcore, meaning you work overtime every day like nuts, or you get fired. And there's a lot of people just saying, I'm leaving. That's really bad for Twitter, and I think it's going to fail. I wouldn't want to be in that company or invested in that company. Let me see. Okay, so this FTX is just a really good lesson learned to not put all your money in one basket, number one. Number two, if you have any money into into this type of investment, it's not an investment, and just try to sell it before there's a big sell-off and everyone starts to sell out at one time. Let me see. Okay. But I'm just very surprised that a large number of institutional investors were suckered into investing into this FTX, which filed for bankruptcy. And I mean, it was based out of the Bahamas, so they don't have a whole lot of corporate controls there. It's just weird. I'm thinking the whole sector that's going to happen to almost every cryptocurrency. Let's see what else. Okay, so we have J.P. Morgan. Jamie Dimon is still saying that there is a hurricane coming in 2023. For us, the most important thing for us to do is to keep monitoring rats. I think I lost control of this. There it is. Okay, is to keep monitoring the stocks we're following, and just to see if there's any changes in the fundamentals, in the expectations. Look at Google, see if that's changing at all. Oh, that's not working. Okay, that's not working very well. We'll go on to the next thing here. Okay, let's look at on the tech stocks. It's fairly valued. It's down 1.5% today. Let's look at the statistics on Google to see if okay, let's look at the earnings estimates. 4.72 divided by 5.30. 10% next year. 5.30 divided by 6.13. 12%, 13%. 6.13 divided by 7.52. Okay, 19%. All right, so it's still growing around 14% on average. And let's look at the PEG ratio. If it's growing at 14% and its PE is 18, let's do that calculation. 18 divided by, it's 1.28 times overvalued. But that matches this PEG ratio there. So it's still a little bit overvalued, but the important thing for Google is it's still consistent over time. So it's going to be growing maybe 9%. The next year there's a recession, but it's still growing. It's a compounder. So that's something you do for everything that you own, just to keep track on what you own, and you have to know what you own. It's very important. And let's look at the stochastics one last time. I have a little bit more time. Okay, you can see that almost every one of these stocks is bouncing up against its upward channel, and it's overbought. So you can see that same overbought upward channel. Even look at this, Alibaba is kind of breaking out just a little bit. And Alphabet, it's near the top of the channel. So almost every stock, even the dividend payers, this is oversold Altria. Amazon, it's kind of in the middle, and it's in the middle for stochastics. AT&T is kind of right in the middle. You see Bristol Myers at the top. Colgate, very consistent in this pattern. Procter & Gamble, it's at the top of the range, it's overbought. So we have almost every stock we're following, most of them are at the top of the channel and overbought. Okay, and so we expect, unless there's something major in the interest rates or, maybe earnings, which probably won't happen. We're probably going to go down to here as the next step. Almost every one of these stocks. Visa, Waste Management, it's in its own little world. It's in an uptrend, similar to Pepsi, and it has basically almost one competitor, and they keep raising rates, and they have a consistent amount of business in a recession environment. And Amgen, that's still going up. CVS is in a halfway. It's probably oversold right now. And Johnson & Johnson is pretty much in a consistent sideways pattern. And it's pretty much overbought right now. Walmart, it's overbought too, and it's probably at the top of its range. And this is interesting. Tractor Supply was like sideways for a while, and now it's kind of almost breaking out of that sideways and kind of going into an uptrend. See, and Berkshire Hathaway is it's pretty much in the sideways, still in the sideways. MasterCard. Okay, so most of the stocks we're following are at the top of the channel and overbought. So that doesn't make it very interesting time to start buying things. So I think that's all the time I had. I think that's. Are there any questions? Anything anyone wanted to go over? No, that's enough.